There is a peculiar and largely unexamined threshold that appears, quietly and persistently, across multiple decades of household financial data. A specific numerical marker that seems to function as a kind of invisible membrane separating two fundamentally different modes of economic existence, and that number, adjusting for the slow creep of inflation and the regional variations that make national averages so treacherous, hovers somewhere in the vicinity of $327,000 of net worth. This is not a figure that appears on any government form or in any official proclamation, nor is it a target that financial advisors routinely present to their clients as a milestone worthy of celebration. Yet, when researchers drill into the deep stratigraphy of American household balance sheets and attempt to correlate financial standing with reported measures of life satisfaction, reduced financial anxiety, and a sense of durable security, a distinct and unmistakable pattern emerges from the noise, a pattern that statisticians recognize as an S-curve or sigmoid function, where the relationship between money and well-being is not a straight line of diminishing returns, but rather a lazy, stretched-out letter S that begins flat, rises steeply through a critical inflection zone, and then flattens once again into a high, stable plateau. And the precise midpoint of that steepest segment, the inflection point where the slope of the curve is at its maximum, and where each additional dollar of net worth produces the largest measurable increase in subjective financial peace, is that strange and specific number, $327,000. To understand why this number holds such peculiar power over the American household psyche is to understand something essential about the mathematical architecture of security itself, and to understand something even more essential about why so many people remain trapped on the wrong side of the inflection point despite earning incomes that should, by any rational accounting, have carried them across it long ago. Before we can fully appreciate the significance of the number itself, we must first establish what the S-curve of satisfaction actually represents and how it differs from the more commonly cited research on money and happiness that has filtered into the popular consciousness over the past decade. You have likely encountered some version of the finding that happiness increases with income up to a certain point, often cited as $75,000 of annual household earnings, after which the correlation between more money and more day-to-day emotional well-being effectively flatlines, and additional income ceases to purchase additional joy. That finding, which emerged from the work of Daniel Kahneman and Angus Deaton and has since been replicated, refined, and occasionally contested, refers specifically to what researchers call experienced well-being, which is the quality of your moment-to-moment emotional state as you move through the hours of an ordinary day. The frequency with which you smile, laugh, or feel content versus the frequency with which you feel stressed, sad, or worried. The S-curve we are examining today operates on an entirely different dimension of human experience, one that is less about the texture of your Tuesday afternoon and more about the deep, ambient, structural sense of whether you are safe in the world and whether the ground beneath your feet is solid or perpetually threatening to give way. This dimension is sometimes called evaluative well-being or life satisfaction, and it is measured not by asking you how you felt yesterday, but by asking you to step back and assess, on a scale of 1 to 10, how your life is going overall, how close it is to your ideal, and how secure you feel about its trajectory into the future. And it is here, in this slower, more deliberative, more architectural mode of self-assessment, that the S-curve reveals its distinctive shape and that the number $327,000 emerges as the mathematical hinge upon which the entire structure swings. The reason the relationship between net worth and life satisfaction assumes an S-curve rather than a simple straight line is rooted in the fundamental mechanics of how financial security interacts with the human nervous system's perception of threat and safety. At the very bottom of the curve, where net worth is negative or hovering just above zero, the relationship between additional wealth and additional satisfaction is surprisingly flat. And this flatness can be disorienting to those who have never occupied that region of the financial landscape themselves. When you are truly struggling, when every dollar that arrives is already spoken for by a creditor or a landlord or a utility company that has begun sending increasingly urgent notices, an extra $1,000 does not produce a proportional increase in your sense of well-being because the $1,000 does not fundamentally alter the underlying geometry of your situation. The hole you are standing in is simply too deep, and the $1,000, while desperately needed and immediately deployed, disappears into the void without changing the fact that you are still standing in a hole. This is the flat left tail of the S-curve, a region characterized by a kind of numb, exhausted persistence where the correlation between incremental resources and incremental peace of mind is dampened by the sheer gravitational weight of the deficit. Moving from a net worth of negative $20,000 to negative $10,000 is mathematically a 50% improvement in your balance sheet. But experientially, it feels like treading water in a storm while wearing a slightly lighter anchor. And the survey data reflects this with satisfaction scores that barely budge across what should, on paper, be a meaningful range of financial variation. Then, at a threshold that varies by household size, geographic location, and the specific composition of one's obligations, but which consistently clusters in the low to mid five figures of positive net worth, something begins to shift in the data, and the flat line of the left tail starts to tilt upward, slowly at first, and then with gathering momentum. This is the beginning of the steep middle segment of the S-curve, the region where each additional dollar of net worth begins to produce measurable and meaningful increases in reported life satisfaction. And the reason for this acceleration is that the household has finally cleared the zero bound and is no longer operating from a position of fundamental deficit, but is instead beginning to accumulate a thin, fragile, but genuine buffer against the ordinary financial shocks of life. A car repair no longer means choosing between the mechanic and the grocery budget. It means a temporary setback that can be absorbed without cascading consequences. A medical bill no longer triggers a spiral of collection calls and sleepless nights. It becomes a problem to be solved rather than a crisis to be survived. This is the region where money begins to function as what it truly is at its core, not a scorecard or a status marker, but a layer of insulation between a household and the sharp, unpredictable edges of the world. And as that insulation thickens, as the buffer grows from 1 month of expenses to 3 months to 6 months, the nervous system begins, very slowly and very tentatively, to relax its vigilance, and the survey responses begin to climb in a pattern that, when plotted on a graph, forms the unmistakable upward sweep of the S-curve's steepest slope. And it is precisely here, in the middle of this steepest segment, that the number $327,000 locates itself with a consistency that demands explanation. This figure, which has emerged from multiple independent analyses of the Federal Reserve Survey of Consumer Finances and has been corroborated by longitudinal studies tracking the same households over time, represents the approximate net worth at which the average American household transitions from a state of ambient financial anxiety to a state of ambient financial equilibrium. It is not the point at which a household becomes wealthy in any meaningful or ostentatious sense of that word. $327,000, when decomposed into its constituent parts, is typically a modest home equity stake combined with a retirement account balance that is on track but not yet fully funded, and an emergency reserve that is adequate but not lavish. It is, in other words, the net worth of a household that has done the quiet, unglamorous work of establishing a foundation. A household that has likely owned a home for a decade and watched a portion of its mortgage payments transform into equity while simultaneously contributing enough to a workplace retirement plan to have crossed the psychological threshold where the account balance begins to generate its own internal momentum. The number is not a goal to be chased for its own sake. It is an emergent property of a household that has successfully navigated the first 2 decades of its financial life without making any catastrophic errors and without suffering any devastating strokes of bad luck that exceeded its capacity to absorb them. And yet, despite its unremarkable origins, this number marks a genuine and measurable inflection point in the lived experience of financial life. A point at which the curve of satisfaction steepens dramatically because the household has finally accumulated enough mass to generate its own modest gravitational field of security. The mathematics that underlie this inflection point are both straightforward and profoundly revealing when examined closely. Consider the typical composition of a household net worth that has reached $327,000. After excluding the value of primary vehicles, which depreciate and are more accurately classified as consumption tools than as true assets, and after setting aside the modest cash reserves that most households maintain for transactional purposes, the bulk of this net worth is concentrated in 2 primary categories: home equity and tax-advantage retirement accounts. Home equity, for the median household that has reached this threshold, accounts for roughly $150,000 to $180,000, representing a property valued in the low to mid $400,000 range, with a remaining mortgage balance in the mid $200,000 range. This equity position is significant not primarily because of its dollar value, but because of what it represents in terms of housing cost stabilization, since a household with substantial equity and a fixed-rate mortgage has effectively locked in its largest monthly expense at a level that will not rise with inflation or with the whims of a landlord. And this locked-in cost structure provides a kind of predictability that is invaluable to the human nervous system. The retirement account component, meanwhile, typically sits in the range of $100,000 to $150,000, a balance that, while insufficient to fund a full retirement on its own, is large enough that the household can reasonably project, using conservative assumptions about future contributions and market returns, a path to a dignified and timely exit from the workforce. The psychological weight of this projection is immense because it transforms retirement from an abstract and vaguely terrifying unknown into a solvable equation with visible variables. And the mere act of being able to see the path, even if the destination remains many years distant, produces a measurable reduction in the ambient hum of financial anxiety that accompanies daily life. The reason the S-curve steepens so dramatically at this precise inflection point is that $327,000 represents the approximate net worth at which the compounding effects of asset ownership begin to outpace the erosive effects of inflation and the friction of daily living expenses. Below this threshold, a household is primarily a labor entity, converting hours of work into dollars that are then immediately deployed to meet current obligations, with little left over to accumulate into the kind of productive capital that generates its own independent returns. Above this threshold, the household begins to function in a modest but meaningful way as a capital entity, with a portion of its economic output coming not from the sale of its labor, but from the appreciation of its assets and the reinvestment of its returns. A home that appreciates at a long-term average rate of 3 to 4% annually is adding $10,000 to $15,000 per year to the household's net worth without requiring any additional effort or sacrifice from its occupants. A retirement portfolio that compounds at a conservative 6 to 7% nominal return is adding $6,000 to $10,000 per year to the household's long-term security, again, without any direct exertion from the household members beyond the discipline of leaving the account undisturbed. These silent, invisible contributions from the asset side of the ledger are what finally tip the balance, what finally allow the household to feel that it is no longer running on a treadmill that is inclined against it, but is instead moving forward under its own accumulating momentum. The steep segment of the S-curve is, in essence, the region where the household transitions from being a net payer into the economic system to being a net recipient of the system's compounding returns. And $327,000 is the approximate net worth at which that transition for the median American household becomes fully and irreversibly established. When we zoom out from the individual household balance sheet and apply a systemic lens to this S-curve phenomenon, a more troubling picture begins to emerge. One that explains why the distribution of net worth in the United States has assumed the shape that it has, and why so many households remain stranded on the flat left tail of the curve, despite decades of diligent effort. The steep middle segment of the S-curve, the region where each additional dollar of net worth produces the largest marginal increase in life satisfaction, is also the region that has become increasingly difficult to enter and traverse in an economic environment characterized by stagnant real wages, escalating housing costs, and the gradual disappearance of the defined benefit pension plans that once served as an automatic escalator carrying workers through the inflection point without requiring any conscious effort or financial literacy on their part. The median net worth of American households, depending on the specific survey methodology and the year of measurement, hovers somewhere between $120,000 and $190,000. A figure that places the typical household firmly on the lower half of the steep slope, still climbing, but not yet having reached the inflection point where the curve begins to work in their favor. And beneath that median lies a vast distribution of households with net worth figures that are far lower. Households that have not yet cleared the zero bound, or that have cleared it only to be pushed back below it by a medical event, a job loss, or the simple, relentless pressure of expenses that outstrip income by a small but persistent margin year after year. The S-curve, when viewed at the systemic level, is not a description of a universal human experience, but rather a map of a landscape that large segments of the population are systematically prevented from traversing. And the number $327,000, far from being a universal milestone, is for many households a distant and receding horizon that grows more difficult to reach with each passing cycle of rent, increases, and inflationary erosion. This systemic perspective reveals a deeper and more uncomfortable truth about the relationship between net worth and satisfaction, which is that the S-curve itself is not a fixed feature of the economic landscape, but a moving target that shifts in response to the broader monetary and policy environment in which households are embedded. The number $327,000 is not a constant of nature like the speed of light or the gravitational constant. It is an artifact of a specific moment in the evolution of American household finances, a moment characterized by particular interest rates, particular housing market dynamics, and particular expectations about the future trajectory of both. If housing costs continue to rise faster than wages, the amount of equity required to achieve the same degree of housing cost stabilization will rise in lockstep, pushing the inflection point higher and further out of reach. If the real returns available to retirement savers decline due to demographic shifts or changes in global capital flows, The portfolio balance required to project a viable path to retirement will increase, again shifting the inflection point upward. The S-curve is a moving walkway that is tilted against those who have not yet stepped onto it, and the speed and steepness of that tilt are determined by forces that operate far above the level of any individual household's decisions or discipline. This is not an argument for despair or resignation, but rather a call for a more sophisticated and less self-blaming understanding of why the climb feels so arduous for so many, and why the number that marks the transition to durable security seems to recede even as they continue to put one foot in front of the other. Given this understanding of both the mathematical structure of the S-curve and the systemic forces that govern its position and accessibility, the identity shift required to navigate toward the inflection point with clarity and intention is a subtle but important one. The shift involves releasing the notion that $327,000 is a specific target to be pursued, and instead embracing the understanding that it is a descriptive marker of a particular state of financial equilibrium, a state that is achieved not by focusing on the number itself, but by focusing on the underlying asset accumulation that produces the number as a byproduct. The household that reaches the inflection point does not do so by obsessively tracking its net worth and celebrating when the digits align. It does so by consistently directing a portion of its income toward the acquisition of appreciating assets, by maintaining a fixed-rate mortgage on a reasonably priced home in a stable community, by contributing enough to its retirement accounts to capture any available employer match, and then incrementally increasing that contribution as income allows, and by resisting the persistent cultural pressure to convert accumulating equity into immediate consumption through cash-out refinances or home equity lines of credit. These behaviors, performed steadily and without drama over a period of 10 to 20 years, are the engine that propels a household up the steep slope of the S-curve, and the inflection point, when it is finally reached, arrives not as a dramatic revelation, but as a quiet, almost imperceptible shift in the background hum of daily life, a gradual dawning awareness that the ground beneath one's feet has somehow become more solid than it used to be. This identity shift also involves a recalibration of how one measures progress along the journey. In the early years, when the left tail of the S-curve is flat and net worth gains are swallowed by the interest on student loans or the depreciation of a used sedan, it is easy to become discouraged and to conclude that the effort is futile and that the destination is unreachable. But the mathematics of the S-curve contains a hidden encouragement for those who persist through this flat region, which is that the steepest part of the curve lies just beyond it, and once a household clears the zero bound and begins to accumulate its first $50,000 of positive net worth, the slope begins to tilt in its favor, and the compounding effects that were previously working against it begin to work for it. The first $100,000 of net worth is, by a wide margin, the most difficult to accumulate, because it must be assembled almost entirely from the surplus of labor income over living expenses, a surplus that is constantly under siege from the ordinary frictions and emergencies of life. The second $100,000 is meaningfully easier, because a portion of it is generated by the assets that were acquired during the first leg of the journey. And by the time a household approaches the inflection point of $327,000, the balance has shifted decisively, with the assets themselves doing an increasing share of the heavy lifting and the labor income serving more as a supplement than as the sole engine of progress. Understanding this dynamic and trusting its mathematical inevitability, even when the early years provide little visible evidence of its operation, is perhaps the most important psychological adjustment that a household can make, because it provides the patience required to endure the flat left tail and the discipline required to continue making the contributions that will eventually ignite the compounding engine. In the final analysis, The number $327,000 is not magic in any supernatural sense, nor is it a guarantee of happiness or a ticket to a life free from worry and struggle. It is, rather, a statistical artifact that reveals something true and important about the structure of financial security in a modern economy. A numerical shorthand for the point at which the mathematics of compounding and the psychology of safety converge to produce a measurable inflection in the lived experience of financial life. The S-curve of satisfaction, with its flat left tail, its steep middle slope, and its high, stable plateau, is a map of the terrain that every household must navigate, and understanding the shape of that terrain, including the location and significance of its inflection point, is an essential piece of navigational equipment for anyone seeking to cross it. The journey up the steep slope is long and often lonely, marked by years of quiet discipline and the deferral of immediate gratification in favor of a future security that remains, for much of the journey, frustratingly abstract and intangible. But the data is clear and consistent on this point. The slope is real, the inflection point exists, and for those who persist through the flat years and continue the steady, unglamorous work of converting labor income into appreciating assets, the moment arrives, quietly and without fanfare, when the ground beneath their feet finally stops shifting and begins to hold. That moment, when it comes, is worth far more than the number on the statement would suggest, and understanding the mathematical architecture that makes it possible is the first step toward reaching it.